More than $6.6 trillion is traded on the Forex market every day, making it the biggest financial market in the world. Retail traders are drawn to Forex trading due to the fast-paced nature of the market, and since it offers daily opportunities to make returns, it's easy to see why. Hello and welcome back to the Finance Guardian channel. For you to make money with Forex, you have to gain a deep understanding of how Forex trading works. Having said that, you came to the perfect video because this is Forex Trading for Beginners. Don't forget to hit that subscribe button and the bell beside it, and let's get started. Forex trading involves exchanging one currency for another on the financial markets. It may be as simple as exchanging your pounds for euros before you leave on vacation, but when we talk about Forex trading in an investment context, it usually refers to the process of speculating on a currency's value for potential gains. As per the Tokenist, over 170 currencies are being traded on the Forex market, which is said to be the largest and most liquid market worldwide. Since this market is so large and accessible, retail traders around the world attempt to get returns on their capital every single day. Interestingly, retail traders account for only a tiny percentage of global trading volume, the majority of which comes from banks and large financial institutions. Since the Forex market has so many moving parts, we'll break down some of the most important elements to help you understand how it works and how you can get involved. Forex currency pairs. First of all, it's important to understand that when you trade a currency in the Forex market, you will actually be trading a currency pair. It may seem a bit confusing at first, but it just means that you're trading one pair against another. The first listed currency in a currency pair is referred to as the base currency, and the second listed currency is known as the quote or variable currency. For example, if you were trading the British pound against the dollar, it would be quoted as GBP/USD. Forex trading works by traders speculating on the rise in the base currency versus a decline in the quote variable currency. Suppose you were expecting the British pound to appreciate against the dollar, you would then open a buy position in the GBP/USD currency pair. In the event the British pound continued to rise in value while the dollar declined, you would make a profit. A wide variety of currency pairs are available for traders, ensuring they have lots of options to choose from in the market. Major pairs are the most liquid and most frequently traded by both retail and professional traders. Minor pairs are less traded, but you can also present some great opportunities for traders. Finally, exotics are currency pairs that are rarely traded and have relatively low liquidity, which is why they are best left for advanced traders. Foreign exchange markets are open 24 hours a day, 5 days a week. Considering that the market is global, there will be times when markets are slow or certain days over the weekend when markets are closed. The Forex market opens on Sunday afternoons at 5 p.m. EST and closes on Friday afternoons at 4 p.m. EST. Between these times, the Forex market is available to all participants across the globe via different sessions, such as the London, New York, and Asian sessions. Accordingly, there is a correlation between the time of day at each location and its level of trading activity. Forex market and trading platforms. In the past, Forex brokers would buy and sell currencies on behalf of their clients, and they usually had their own protected trading strategy. Today, anyone can trade through online trading platforms. Let's look at a few examples of different types of Forex markets to consider. Number 1. CFDs. CFD is short for contract for difference. It is a contract that can provide exposure to asset value fluctuations without requiring the underlying asset to be owned. FX brokers will usually offer CFDs in order to ensure a seamless trading experience and the ability to leverage positions. Number 2. Spot. By doing spot trading, you buy or sell a currency on the spot at its current market price. FX trading is conducted largely in this manner because spreads are narrower, making it easier to trade quickly. Number 3. Futures. Essentially, futures are a type of contract between two parties to exchange a certain currency for a specific price at a future date. These contracts can be used both for speculation and hedging. Number 4. Options. Traders can use options contracts to buy or sell a currency at a predetermined price or date in the future, but they're not obligated to do so. As with the futures contract, these can be employed for both speculation and hedging, including if you are dealing with Forex options. Forex pips and spreads. Forex trading for beginners requires knowing what pips and spreads are. To put it simply, pips are a unit of measurement used to gauge changes in the value of a currency. In most currency pairs, a pip represents a change in the fourth decimal place of a currency quote and stands for percentage in point. For instance, if the GBP USD is quoted at 1.1950 and 10 pips happen to be added to the currency, then the GBP USD will now be quoted at 1.1960. Spreads represent the difference between bid and ask prices offered by brokers. The bid price refers to the cost to buy a specific currency, while the ask price is the money you'd receive to sell a specific currency. It's common for these to differ since your broker gets a cut as a sort of commission for helping you facilitate your trade. Variables such as volatility and liquidity can lead to a wide widening or narrowing of spreads during trading hours. The wider the spread, the higher the fee you will pay to trade that currency, so you should use a broker that offers tight spreads. Forex trading strategies. If you have never traded Forex currency before, your best bet is to develop a game plan before you enter the markets. Without a strategy, trading the Forex market will be a surefire way to lose money, so making a plan beforehand is a sound Forex foundation for novice traders. These 4 trading strategies are some of the most popular ones among FX traders, although there are many more out there. Number 1. Day trading. On the same day, traders will open and close a position. This eliminates the risk of large overnight market movements. Either you will have a profit or a loss by the end of the day. Day traders seek to build profits over time by making small gains and identifying currency positions throughout the day. Using tools such as the Relative Strength Index, they can find trends and develop the best day trading strategy based on technical analysis. Number 2. Forex scalping. It is a form of short-term Forex trading, but it is also known to be a way to trade intensely. Scalp traders employ an intraday trading strategy which allows them to hold positions open only for a few seconds or minutes at most before closing them again. The trading strategies they employ target small price movements during the busiest hours of the day when major currency pairs such as GBP/USD are more volatile. You can use a Forex scalping strategy if you want to make a lot of quick trades and focus on the small gains that day trading strategies enjoy. The more transactions you execute during a day, the greater your overall profits will be. But mind you, this method can be very stressful. Number 3. Position trading. Using position trading, you can take advantage of long-term price movements when currency rates fluctuate, allowing for the maximum potential profit. These long-term positions could last from weeks to months or possibly even years with a focus on the broader market picture. The success of position trading relies on traders not worrying too much about minor price changes. Instead, they can use technical analysis tools to identify any future upward or downward trends that may arise and build their trading strategy around them by analyzing the weekly and monthly price charts of the market. Number 4. Swing trading strategy. Swing traders often hold their positions for several days to a few weeks. They do not have to continually monitor price charts or small fluctuations in the market throughout the day. This is the most popular and successful Forex trading strategy because it is suitable both for beginners and people who may have other responsibilities in the day. But we'd suggest that you still dedicate a few hours of your day to analyzing and evaluating the market. How risky is Forex trading? Forex trading involves some risks as with any investment. The inherent volatility of Forex markets makes them so popular. However, this volatility can also work against you and result in losses. This is why it is important to balance risk and reward. You should never risk more than you can afford to lose. There are many different types of risks to consider, but one of the most likely ones is related to news or data releases. The effects of these market events can be pronounced by large spikes in volatility on a currency's price. When you choose the right direction, trading the market around these events can be profitable, but if you don't, it will be disastrous. The Forex market is risky by nature, but by employing a proper strategy and correct risk management, you can substantially reduce that risk. If you do so, you'll have a good shot at becoming an effective trader and generating positive returns. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, subscribe to our channel to remain updated about all of our future videos. We'll see you next time.